Morning. Welcome to Trading Hour. It's a Monday morning. I'm Reema Tendulkar. With me is Sonal Bhutra. And after a quiet start, things are picking up for the market. So the last 30 minutes, have been positive for our markets. We're up close to about 75 points in the Nifty. The Sensex up close to about 200 points.
And the pickup in midcaps is also something that has come by very swiftly. It was in the red, but the index is now up 187 points. And if we look at the sectoral moves as well, across the board, we are seeing a green tinge. So there is no sector which is in the red right now. 40 out of 50 Nifty stocks are in the green today, be it the PSU banking index, which is the top gainer right now. We have CPSE index. So we have the likes of Oil India, GAIL, ONGC, Petronet LNG, all of them doing really well ahead of the budget as well. So there's a lot of positivity in that particular space. Oil India was doing well on Friday, up 11%, adding another 1% today. Look at that, GAIL is up around 2.5%. So it's across the board. Even autos have made a comeback today. And Pharma index is the other big gainer. So it's very sectoral, but still it's green across the screen.
In autos particularly, tire is the hot pocket today. We'll talk more about it, but I was just checking the valuation. So for instance, JK Tire, which is up close to about 10%, is trading at 10 times FY26 PE. So we keep talking about the market being expensive, but MK had come out with a note towards the end of June, 28th of June, I think. And that note has put the EPS, FY26 EPS of JK Tire at 49.4. So assuming 50 rupees approximately, the stock is still at 10 times forward multiples. I thought that was quite interesting.
Yes, and it looks like it's the most sensitive to the price hikes as well. We don't know if JK Tire has gone ahead or not, but MRF doing it, and that is something.
Apollo had hiked on the 1st of July.
So it's just an indication that maybe the entire sector would do that. And Manisha has been telling us what's happening with the rubber prices. So that's about, of course, tire sector. We'll discuss it in greater detail. But the stock of the day, of course, is HCL Tech as well. What did the numbers look like?
Well, decent numbers, but the stock has started moderating a bit because it's had a pretty good run even on Friday's trade. So the stock was up close to about 3.5–4%. But now, as you can see, the gains have whittled down a bit. So it's up 1.3%. Now, Q1 was ahead of street expectation on revenues and margins. But what it's done is, with TCS also reporting a better than expected numbers, HCL Tech being higher, it's rekindled hopes about an IT recovery. Even though none of the managements are calling out a turn in demand, a pickup in discretionary spending. The Nifty IT index today went and hit all-time high levels. Now, Motilal Oswal today says they're valuing HCL Tech at a premium to Infosys, and the premium is 10%. So they've upgraded the valuation multiple by 10% for HCL Tech to 27 times. They're saying HCL Tech will most likely outperform Infosys for 3 straight years on growth. The company's free cash flow metrics, FCF metrics, have meaningfully improved over the past 3 years, and it's now comparable to both Infi and TCS. And therefore, according to Motilal Oswal, HCL Tech remains the top pick in the large cap space. They've put a target price at 1850. That said, not all are believers. CLSA has downgraded the stock to a hold and put the target price at 1550. We had quite a long chat with the management earlier today. We spoke to them about their annual guidance of 3 to 5%, how they're going to achieve it. Because in Q1, the company's revenues dropped by 1.6%. So they've had a soft start to FY25. So the confidence in achieving their full year guidance, the outlook on margins, because their margin guidance is 18 to 19%. In Q1, their margins is 17.1%, and they still have to give a wage hike. So there is that fear, right? How will you achieve your margin guidance? Because wage hikes typically will depress it whenever you announce it. They've not decided the date yet. So we chatted with the comfort on achieving the revenue margin guidance, the outlook on discretionary demands, how the near term is going to pan out. Listen in to some important comments.
This guidance of 3 to 5% is something which we gave in the beginning of the year. And we did factor in the first quarter softness, which is quite similar to the previous years. And of course, Q2 is going to be a growth quarter, and Q3 is where we usually deliver peak performance. And at this point, we feel confident of the overall guidance for the year. In the last 7 quarters or 8 quarters, there has been differing kind of signals that we've been getting, and sometimes the ramp-ups are very short cycle and things like that. So that's why I've not called out any pickup in demand. The demand situation remains pretty much the same as what we had talked to you 3 months ago. when we gave the annual guidance.
If you see even our last 2 years, the quarter-to-quarter trajectory has been, the first quarter is the weakest, around this 17% in both the previous years as well. And then it's the second quarter where we pick up to, let's say, somewhere around 18%. And then the third quarter is the peak, driven by the software seasonality, which is our most profitable segment, as you know. And then the fourth quarter is kind of near the annual average, again, just like Q2. So that's the trajectory, and we seem to be following that. The wage hikes, last year itself was a delayed cycle, delayed by a quarter for everybody practically. So we'll have to see what we do this year. We haven't still made the decision, as we discussed on Friday as well.
I think our overall bookings came in quite in line with our last few quarter trends. We've been clocking about $2 billion of net new TCV for the last several quarters, with the exception being the Q2 of last financial year, where we had a big spike in the deal wins. This quarter, we expected it to be a little more, maybe 2.3, 2.4, and a couple of deals got moved to the next quarter. It is really nothing to do with anything to do with the macro or anything like that. It is just that the logistics of getting an agreement signed got delayed, and we expect that to happen in this quarter. Pipeline remains pretty much at the same levels as what we had in the beginning of April. We are expecting growth in all verticals. We also expect to grow in all geographies. However, two things to call out: financial services would decline because of the divestment that we had announced. And for the software business as well, it is a little bit weaker in the July, August, September quarter.
Okay, all right. That's the word coming in from HCL Tech Top Management. With that, we'll sip into a break. Up next, we'll discuss what's buzzing in commodity space with Manisha Gupta. Stay tuned for that. Are on CNBC TV18. Before we talk about the commodities, let's just take a look at some of these stocks. Apollo Tyres, we were discussing what's happening in the tire space. That stock is up 5% right now. Following this one is India Cements. The stock is buzzing today, up 3.5%. We've been talking about the consolidation, the big stake buy in India Cements by Ultratech Cements. So that stock is up 3.5%. GAIL, Petronet LNG, ONGC, NTPC, some of these names from the oil and gas PSU space, that's doing really well. GAIL, we talked about it earlier, but ONGC also has picked up pace. So that stock is up around 2%. NTPC is the other one, which is up around 1.8%. PSU banking names, Bank of Baroda, this PNB, all of them higher in trade, anywhere between 2 to 4%. But let's talk about commodities now. Manisha joins in, and today we are focusing on rice. Manisha, what's happening there?
Oh, well, yes, you were talking about the tire companies, and rubber is trading at a 13-year highs, by the way. We've seen further surge in the international markets onto that one. But yes, coming back to rice, and this is a commodity that actually has seen constant declines. You know, for this year, we started with nearly 17 cents in the international markets. We saw the prices go up to all the way to 19 cents as well. And currently, with 17% of a decline in last 1 week itself, with the major falls coming in the overnight markets in US, we are now trading at 14 cents. So a very sharp decline from its highs and from where we started this year as well. Well, rice has been declining because India, which is the world's largest rice exporter, could be coming back into the market. We are looking at a higher surplus this time around. The crop is also expected at 141 to 142 million tons. So that's quite on the higher side. And that means that you will see some rice coming back into the international markets. While, of course, some is going to be sold into the open markets within India as well. We have seen a notification to that effect already. And the new crop in Indian markets also will start coming into the month of October. The sowing numbers have been on the stronger side in any case. The feeling, or rather the kind of statement that we have seen go around via officials and via sources is that India could allow white rice exports with some of those restrictions taken over. The parboiled rice could see 20% of tax being taken off, and a fixed duty could be allotted there. The crop estimates, as I said, have been on the higher side, and that has been putting pressure not just in the Indian rice prices, but the global rice markets as well.
Okay, thank you very much for that. We will slip into a very short break. We'll come back and address the market technicals. Soni Patnaik from GM Financial Services joins in on the other side. Welcome back. One of the big movers today is Tanla Platforms. I think it's up close to about 8 to 9%. The company has announced to the exchanges that they've signed a commercial agreement with one of the global tech majors to combat scams on their messaging platforms by identifying fraudulent phone numbers. So the size of the deal has not been disclosed on account of confidentiality reasons, but they have signed a commercial agreement with one of the global tech majors. The stock is up 10% today, but it's still down 20% from its 52-week high, which is above 1,300, and the lifetime high on the stock is more than 2,000. So the stock is off nearly 50% from its all-time high levels. Remember, they declare the Q1 numbers later this week on 18th, and it also will, there is a dividend play. It goes ex-dividend on 18 by 6 rupees. So that's the other bit of news.
Since the time it changes name from Tanla Solutions to Tanla Platforms, I believe we saw that big surge. But yes, now it has come off, as Rima mentioned, from those levels of 2,000 rupees a share. But the other stock on our radar is Avenue Supermarts. We'll discuss about that in greater detail because that is the one which is reacting to its earnings. But a lot of names which are in focus. So before we get to those names, let's get in Mangalam to talk about the numbers here. Mangalam.
Well, for Avenue Supermarts, you know, what we had already was a standalone revenue growth, and that was about 18%. The street liked that because that implied a near 5 to 6% same-store sales growth. So to that extent, what was important in these numbers, the consolidated numbers, was one, how the gross margins have performed. Secondly, how DMart Ready, the e-commerce business, has performed as well. And on those fronts, you know, the company has been showing some strength. So gross margins for the company in the first quarter have increased both year-on-year as well as quarter-on-quarter. Product mix has also increased or improved as contribution from general merchandise has increased. Higher employee and other expenses have actually limited EBITDA margins to around 8.7%. So that's kept them stable despite an increase in gross margins. And DMart Ready, the e-commerce venture, has grown 27% to about 357 crores this quarter. And that's a number which is implied. So overall, revenue growth has been around 18.5%. EBITDA has grown around 18% with margins at around 8.7% and net profit at around 17.5% higher as well. What is it that the company said on the operating costs? They said that they've gone up due to continuing effort towards improving service levels and building capabilities for the future. And this is something that they've said in our interview as well, where they said that, you know, going forward, there can be some bit of pressure on EBITDA margins, but improvement in gross margins is something that the street likes. The stock, however, is not flying away because, one, it has already seen a decent rally from the lows, and secondly, at 90 times, it is not particularly cheap on a one-year forward earnings basis.
Okay, thank you very much for that. IREDA is up 4.5% after reporting Q1 numbers. Abhishek joins in to give us the details. Abhishek.
Well, strong business momentum has aided the results this time around, although operationally, if you take a look, the operating profits have declined on a sequential basis. The AUM growth, it's at about 33.9% YOY and close to 5.5% sequentially. Quarter-on-quarter asset quality has improved, so gross NPA ratio has come down. Net NPA ratio has also come down by 4 to 5 basis points sequentially. Net interest margin has expanded both YOY and quarter-on-quarter, so net interest margin has come in at 3.29% versus 2.85% in the previous quarter. And our growth is at 37.5% YOY and about 5.5% sequentially. Now, operating profits have declined by 8.9% quarter-on-quarter. That's largely due to the fact that other income has declined on a sequential basis. There is a provision write back of 30 crore versus expense of 9.5 crore in the previous quarter, and that's aided the PAT this time around. PAT is up more than 30% YOY and about 13.7% on a sequential basis. Back to you.
Okay, one-way move on IREDA since the time it has listed, and now on the back of these numbers, the stock is surging again. It's a good time to get a technical check on the market. Soni Patnaik from JM Financial Services is joining us for that. Soni, good morning. Thank you so much for joining us. A swift recovery from the lows. Markets are cheering. It's really not a Monday mood for markets. But tell us what are the next levels you're watching out for on the Nifty and any individual bets?
Good morning, Sonal and Rima. Thank you for having me on the show. I think Nifty, of course, is in a very strong uptrend, and no signs of exhaustion or profit booking just yet. We can see aggressive put writing taking place today at 24,500 put option, continued by 24,600 put option. So it's trying to form a new base of support around 24,400, 500. I think that's the support level to watch out for. If that support breaks, you can see some profit booking towards 24,200 and below that 24,000. But as of now, these straws, the support is getting quite strong. On the higher side, we can see that it can test 24,700, 750 odd levels from current levels. I think that's how the levels are, panned out for the day, and what to be watched out for next. What is lagging over here is the Nifty Bank Index, which is not showing a lot of strength to take out the resistance of 53,000, which is very critical for Bank Nifty. So until and unless 53,000, 53,100 resistance does not go away for Bank Nifty, I think this index particularly can consolidate here with 52,000 as a very good support. If 52,000 breaks, then only we can see some profit booking coming in Bank Nifty, which will also drag Nifty lower. I think as of now, these are the indices level. Stock specific bets quite aggressive. We can see good data option building in today in LIC Housing Finance, which is heading for a fresh target of 820, 830 odd levels. So one can buy at current levels in LIC Housing Finance, keeping a stop loss of 780 in futures and a target of 820, 830 can be seen. The second stock pick comes in Exide, which is consolidating. After testing higher levels of 600 plus levels, it saw some profit booking. It is collecting the strength at this level with a very good support of 550. So one can accumulate Exide Industry for a positional play at current levels with a stop loss of 550 and a target of 580, 600 can be seen.
Okay, thank you very much for joining in. Soni, need to slip into a very short break. We'll come back and talk about market fundamentals. Sunny Agarwal of SBI Securities joins us next.
Welcome back. You're still tuned into Trading Hour on CNBC-TV18. Now, we spoke about the market technicals. It's time to discuss market fundamentals with Sunny Agarwal joining in from SBI Securities. Good morning. Thank you so much for joining us. I just wanted to understand your view on markets right now, because there's nothing that seems to deter Indian markets for sure. We are approaching union budget as well. Do you think ahead of that we could see some more moves, and after budget there could be some profit booking?
Yeah, good morning, Sonal. I think if you look at the valuation, Nifty is trading close to 21 times FY25 earning per share EPS. Although trading at a premium to the MSCI emerging market, but liquidity is something which is keeping market buoyant. So we have seen a very strong liquidity from domestic institution and retail investor participating directly or indirectly. Although FII flows continue to remain volatile, yes, you have rightly pointed out the upcoming union budget is leading to a lot of positivity in the market, and post that we may see some either time-wise or price-wise correction in the market. Having said that, what I feel is that ongoing June quarter numbers will have an stock-specific reaction. So we have already seen two large IT companies, TCS and HCL Tech, reporting slightly better than expected numbers, and we have seen a positive reaction in IT sector. In terms of earning, what I feel is that quarter one, we will see a very good set of numbers from auto and as well as BFSI sector. And if somebody is a long-term investor, I think bottoms-up stories still exist. So we need to identify companies which are likely to deliver healthy earning growth over the period of next 2 to 3 years. So yes, it's a bottoms-up stories are still there in many sectors such as auto-ends, telecom, wealth manager, mining companies, ethanol, so on and so forth.
Particularly about IT, since you spoke about the top 2 IT companies reporting their numbers, have you upgraded any of the stocks or changed your EPS estimates post the numbers? Is there a turn in the demand sentiment? Do you feel differently about IT than what you did 2 months back?
Yeah, so Rima, yes, IT, what I believe is that in the terms of demand environment, it's work in progress. However, after looking at a commentary from TCS and HCL, it seems that the concern on spending cut is at least easing out, and Q2 and Q3 are likely to be a better quarter as compared to Q1 for tier 1 IT companies. In terms of earning growth, I feel, we all know that mid-tier companies like KPIT, Cyient, specifically focusing on ER&D space, are likely to be a relative outperformer in terms of earning growth. And hence, in terms of valuation, although trading at an expensive valuation, since earning growth are relatively better as compared to tier 1 IT companies, we may see a sustenance of expensive valuation in mid-tier IT companies. So yes, at current juncture, mid-size IT companies look much better as compared to large cap IT companies. Large cap IT companies, if somebody really want to invest, maybe an SIP route is the right way, where one can gradually deploy the capital in names like TCS, Infosys over the period of next 3 to 4 months.
By the way, Midcap IT is indeed doing very well. Look at Oracle Financial Services, 5.5% on that. It's crossed the 11,000 rupee mark. A latent view is surging 4.5%, much smaller. Intellect Design Arena is up. These are stocks where you are seeing some buying, incremental buying. And then the others like Zensar continues to remain up 6%, about a 3% gain on Emphasis Science. So many of these mid-cap IT companies are higher.
And that's what's been happening since the time we got numbers from TCS,
the
right?
last 2 days.
Sunny, I wanted your take on EMS players. You like the likes of Sirma, SGS and Amber Enterprises. These stocks have seen a one-way move, expensive valuations, margins in single digits. What's the next trigger for growth here? Do you think at these valuations as well, someone can go ahead and look at these names?
Yeah, I think, yes, I agree that valuations are expensive, but one has to keep in mind that the way government is supporting EMS sector through PLI scheme and the kind of execution which we are going to see across the board, whether it is from a mobile phone perspective, consumer durable perspective, I think the earning growth is likely to be pretty good over the period of next 3 to 5 years. So I believe that expensive valuation, premium valuation will sustain for all the EMS player, and one can look at companies like Amber Enterprises, where we are seeing a diversification of the business from only AC to non-AC sector, fast-growing sector. At the same time, we are seeing a backward integration in the form of component manufacturing. So I think few companies like Sirma, where the earnings has been muted since last 2 to 3 quarters. There I feel FY25 is likely to be good on a low base of FY24. Amber again due to diversification. So I think there are a few names where definitely opportunity exists from a medium to long term perspective.
Okay. What have you made of the up move that we're seeing in tire companies with the price hikes?
I think for tire companies, the price hike at least have addressed the concern that with the rubber prices at multi-year high, at least we will see a better margin for Q2. But what I feel is that Q1, which is the June quarter numbers, will remain muted because of the higher rubber price and margins coming under pressure. So I think I would like to wait for a few more months before taking a call on tire companies at the current juncture.
You like Praj Industries as well as the ethanol play. You think there's still a lot of catch-up that is needed there? There's a lot of move, a lot of chatter around ethanol, but then we saw the diversion of production to sugar versus ethanol. Do you think regulatory risks are something which could continue to plague the sector?
I think, yes, so there was a regulatory risk a few months back, but I believe once the election is over, outcome is there, we believe that the government is still committed to ensure that 20% blending ratio from the current 15%, and that will at least keep order inflow ringing for companies like Praj Industry. Yes, I agree the stock has run up significantly during last 2 years. So maybe buy on dip is the right strategy in a names like Praj Industry to ride on ethanol story.
Okay. Any other, many of the stocks that we've spoken about in the past also, Sunny. So any new ideas that you've had which, SBI Securities has come up with in the last 1 month?
Yeah, so Rima, we are bullish on cables and wire iron segment, and Finolex industry is the one stock where we are pretty bullish on, more of a B2C business trading at a relatively cheaper valuation as compared to RR Cable and Polycab. At the same time, we have seen that companies are going to pursue capex of close to 500 crore over the period of next 2 years. That will add a lot of capacity to their both telecom cable as well as normal electrical cable. And being a B2C business, I feel the lower valuations are not warranted for Finolex Industries. And one can look at maybe 15 to 20% return from Finolex over the period of next 6 to 12 months in Finolex.
Okay, all right. Thank you, Sunny, for joining us today. So those are market fundamentals. The markets, by the way, continue to do well. 80 points are on the Nifty, and the mid-caps, they are powering through. Time for a short break now. When we return, we'll be joined by Karan Taurani of IREDA Capital. We'll discuss Zomato's platform fee hike in Bengaluru and Delhi, and we'll get his take as well. Stay tuned.
Welcome back. Zomato is a stock in on our radar today, 2.5% higher after it hiked platform fees from 5 rupees per order to 6 rupees per order. But this has happened only in 2 markets right now, Bengaluru and Delhi. Mangalam joins in with the details. Mangalam.
Well, Zomato's increased its platform fees in select markets by about 1 rupee per order. 5 rupees has been increased to about 6 rupees. What's interesting about this is that while this noticeable 1 rupee change, may go unnoticed by those who order regularly, when you put all these orders together, it does make a difference to their EBITDA. So, for instance, the company is expected to do anywhere between 85 to 90 crore orders this year. So, a 1 rupee increase in some of its key markets could actually increase their EBITDA by about 40 to 50 odd crores, or 1 or 2% as per analysts. If you look at what Morgan Stanley has estimated, they say that every 1 rupee increase in the platform fee helps the blended take rate or contribution margins by about 20 basis points, or an adjusted EBITDA for their food delivery business by about 5 to 6% as well. But what's important this time around is to note 2 things. One, this hike is not across the portfolio or across their geographies. And secondly, you have to adjust this to the net impact of financial costs in context of discounted prices for gold memberships which are offered during renewals itself. So, you increase the platform fee and reduce the discount that has been offered and make that net, it is still a positive and a step in the right direction, because the overall thesis of Zomato is improving operating performance of the food business with moderate growth and strong growth coming in for Blinkit, along with decent operating performance improvement out there as well. And that would mean that the stock continues to move higher, and today as well has hit a fresh record high.
Okay, yes, 2.5% higher. Thank you so much, Mangalam, for joining us with those details. To discuss more on this, we are now joined by Karan Taurani of IREDA Capital. Karan, good morning. Thank you so much for joining us. Well, tell us, what is your estimate? What would the EBITDA impact be considering the annual orders by Zomato because of this hike?
Hi, good morning. So I think, considering this impact, this definitely is a very big lever for the overall EBITDA margins. We believe that there could be an absolute EBITDA rate of about 7 to 8%. The increase in take rates will be in the range of 25 to 30 bips. And Zomato has seen a consistent increase in their take rates over the last 3 quarters, I think, since the time, platform fee has been introduced.
Okay. And past hikes in platform fees suggest that there is no impact on demand, right?
Yes, absolutely. So, Rima, if you look at the situation here, what happened clearly is that, the loyalty programs right now are offering free delivery, right? And some delivery charges, have become zero for the loyalty customers. But, if you look at the AOV, which is about 400 rupees on an average, the platform fee is getting hiked by 1 rupee. So even if we say that the platform fee goes up to 6 rupees, 7 rupees, or even 10 rupees, the potential impact is not going to be very big. It's not about 2.5% of AOV. Even if it goes to 10 rupees, in the higher end, upper end over the next 2 to 3 quarters. So I think it's happening in a phased manner. The customers are not feeling the pinch at one point of time. And I think that is the good part, in terms of getting the correct blend for profitability for Zomato.
Considering the delivery fee for some of the distances goes as high as 50 rupees as well. So I think a 10 rupee convenience charge or the platform fee is something that at least the gold members wouldn't mind paying as well. But Karan,
it's just that, it's happened fairly quickly because I think it was only in April that it was hiked from 4 to 5 rupees. And then again, 3 months later, it's hiked from, 5 to 6 rupees.
But so Karan, your take here, is there an expectation of a further a hike in this platform fee, and is this something that investors should pencil in as well if they're looking at the stock?
Yes, definitely. So I think this started off last year in the month of August with 2 rupees, went up to 5 rupees in Jan, and then in April, and right now, it's coming up to 6 rupees as well. So the point is that this is a good manner to kind of see offtake, and they are doing it very selectively. They aren't doing it in a blanket manner. They are trying to do it in top 4, top 8 cities, see the response on demand, and then move to other cities. So doing it in a blanket manner may have a negative impact, in terms of the customer demand or in terms of price sensitivity in the markets, which are tier 2 and tier 3 markets where AOV is very low and the percentage, could be higher in terms of the platform fee. So doing it in a phased manner is the correct way to do it. And I think going ahead, you will see further increase in terms of platform fee going ahead as well. And we believe this is a lever for margin improvement, because if you look at restaurant commission rates, we believe they have somewhere plateaued out. Advertising revenue and platform fee are the bigger levers for margin improvement. And we have already penciled this into our estimates, in terms of potential EBITDA margin improvement. Their adjusted EBITDA as a percentage of GOV is about 3.3% today, as on Q4 that is. But going ahead, potentially there is a potential for this to move to about 4.5% over the next 2.5 years. So, this is a lever. It is penciled into our estimates. There's no such big delta which is going to be created. There's no such big upgrade which would happen. This is largely factored into our estimates.
Okay. Just quickly give us the key numbers in terms of FY25. What could be the potential revenue? What's the potential revenue growth? With this, what would the EBITDA margins now stand at on an adjusted basis? And even on the bottom line, what is your own expectation?
So I think in terms of potential growth for the food business, on GOV, we're expecting a growth of about 20%, 18 to 20%. In terms of revenue, we're expecting revenue growth rates to be much higher versus 20% because of increase in take rates. So if you look at take rates currently, they stand to be about 20.6 to 20.7% roughly. I think you'll see an improvement of about 60-70 bips in terms of take rates because of levers around advertising and platform fee. And in terms of EBITDA, as indicated, Q4, the exit was about 3.3% adjusted EBITDA as a percentage of GOV. Potentially, we believe that could also move up towards 3.6, 3.7. And I think over the medium term, we'll find that in the management guided range of about 4 to 5%. So potentially, even adjusted EBITDA could move towards 4 to 4.5%. And I think in terms of valuations, we are assigning it to 55 times, forward EV EBITDA for the food business. And in terms of the target price, we have a target price of 280. And in terms of contribution, we believe that about 40 to 45% of the business would be valued because of the food.
Sorry, you said the adjusted EBITDA this year would be?
Adjusted EBITDA this year, in terms of percentages, would be around 3.6, 3.7% of GOV.
Okay. And when do they get to their target? I think their target was 4 to 5%. So this year, they hit 3.7%, according to your estimates, post this hike in platform fees. How soon before they will that happen in FY26 itself? And what about the ESOP cost? Because that was a drag in the prior quarter. Will that weigh on the margins or overall profitability?
Yeah, right. So in terms of margins, I think the guided range is about 4 to 5%. And, post that, they'll be reinvesting the money in terms of within the business, and, probably, even look at the take rates might even come down to a certain extent. That could also happen because they did indicate of, sharing some kind of, benefit with the restaurant partners as well. But that's a very medium-term thing. So I think, in terms of the margins, as I said, adjusted EBITDA will move towards 4.5, 4.6% by F26 as per our estimates. Secondly, in terms of ESOP cost, I think our margin estimates are clearly after the ESOP cost. So we have already factored in the negative impact of ESOP cost as well, which could be in the range of 40 to 60 bips on annualized basis.
All right, Karan, thank you so much for joining us with your take on Zomato. With that, we'll slip into a short break. When we come back, we'll get you more on the markets and stock-specific action on the other side. Stay tuned for that.